afternoon. On behalf of Morningstar and the team here, I'd like to thank everyone and welcome you to today's webinar session. For those that don't know me, I'm Deborah Graham. I'm an Advice Solutions Specialist here at Morningstar. Before we get started, just a little bit of housekeeping. If you have any questions throughout today's session, you can pop them in the Q&A question box, which you can currently see on your screen. We will also launch some polls during today's session that will ask for your participation. This session will be accredited. We will have a week's wait on the CPD points on this particular presentation, so you can expect those next week to come into your inbox.
Speak up.
We'll just jump into the disclaimer. So if you can take a moment to read that in your own time and know that anything here is not personal in nature. So in our previous webinar, you would have heard from Peter Burns on aligning goals-based advice for your accumulation clients. With clients' goals being at the centre of the advice framework, Morningstar is committed to supporting you in running a modern advice practice and aligning to our three pillars of investment solutions, practice optimisation, and behavioural coaching. This leads us into today's presentation, demonstrating the work Morningstar is doing to solve the retirement challenge. Jody Fitzgerald, Head of Institutional Portfolio Management, and James Foote, Head of Research, and the team at Morningstar have put a lot of work into building the advisor to client tool on the wealth bucketing solution. And this is what you'll get a preview of today. This tool is currently in the alpha testing phase and is with a pilot group in order to gain feedback on its usability. What you'll see today may differ in some ways from the end product based on the feedback that we do receive. We look forward to sharing that progress with you today. And with that, I'll hand over to Jody and James.
Thank you, Deb. There was a comment that the volume wasn't great, so if you can just let me know if I'm difficult to hear, we'll get IT in to fix that. But as Deb mentioned, we have been really busy behind the scenes building out a retirement solution. We wanted to build something that was different to what's actually available in the market, something that's actually going to assist you in guiding your clients in how they can get the most out of their retirement. There are a lot of different products and solutions out there. Products in this space, sorry, my computer was just about to restart. That would have been interesting. There's a lot of products and solutions in the marketplace. The products that we tend to find out in the marketplace at the moment is their insurance style based products, so annuities or capital guarantee style products. Now, these are certainly not one size fits all solution. The biggest issue is that they do actually reduce flexibility for you as the advisor, particularly when you need to access your client's money or when your client needs that money, for unexpected expenses. They also involve significant counterparty and balance sheet risk that you need to monitor regularly, and typically offer consistent income streams that just isn't reflective of how people actually spend their money. We also have rules of thumb that people tend to use when building retirement portfolios. One of the rules of thumb is usually around how much to draw down from those particular assets. In the US, you may have heard of quite a famous rule of thumb, which is called the 4% rule, where you consistently just draw down 4% every year. Here in Australia, people tend to use the minimum account-based pension requirements. Finally, there's also, portfolio construction approaches that people tend to use. If you go back historically, probably one of the bigger portfolio construction solutions that were used in this space was to effectively load your client's portfolio up with term deposits, which were paying significantly high rates. And if that client was underfunded and needed to take risk, you would actually add yielding assets into the portfolio. So quite often dividend-paying stocks like bank stocks, etc. Now, this is an appealing strategy because the client didn't need to take on significant risk. By having most of their assets in a term deposit, it was a reasonably risk-free strategy. But the reality is that is just not going to be a feasible solution, is it, James, in this environment?
That's right, Jody. If we go back 10 years, term deposits averaged 5%. Cash rates were not much less. And we all know that's just not the case anymore.
Yeah. So look, ideally in retirement, people would not take risk, but that's not feasible. And it's not feasible for two reasons. The first is that future expenses and timelines are unknown. If we knew the day that we were going to die, planning would actually be really easy. Potentially not a lot of fun, but easy. But it's not just longevity that's unknown. One of the things that we don't really have any clarity around is some of the bigger expenses that people tend to encounter in retirement. And those expenses tend to relate to healthcare and aged care costs. So this is a prime example of why those insurance-based products are not necessarily fit for purpose for everybody, because they don't offer that flexibility for you to access the capital when these sorts of expenses come along. Secondly, if people were retiring with lots of money, so if you were very, very rich at retirement, again, retirement planning is easy. You would basically put everything in a risk-free asset and create a de facto annuity. But most people can't do that. Most clients are going to be underfunded. And the problem is actually compounded by the fact that we are living longer. So retirement can be a 20 to 30-year proposition. This means that most retirees will need to rely on investment returns to support their spending targets. Now, if retirement is a 20 to 30-year proposition, that means you're having to rely on the uncertainty of markets for a reasonably long time. Now, these two uncertainties together make the problem very difficult to solve. Now, to throw an additional problem into the mix, in today's environment, we're in a very low return environment. So some of those historical techniques that we use, being focusing on yielding assets and static withdrawal rates, are simply unlikely to work going forward.
So as part of this, it's really important to acknowledge that there's not just a single solution. It's not just one way to do things. So retirement planning involves a series of trade-offs. And the challenge for you as an advisor is helping clients understand what these trade-offs mean, bring them to life, help it make sense in a way that's intuitive and a way that's simple. But it's not just about the what. So knowing what to do is certainly one thing, but equally important is actually doing it. So there's a behavioural piece here as well. And for those of you that know us well, will know that we incorporate an understanding of behavioural science into our investment process. Those insights are used here as well. So this tool is designed to combine both cutting edge investment methodology and behavioural science techniques to support you in providing guidance to your clients and ultimately help them make smarter decisions.
So the retirement challenge is actually a fairly easy one to articulate. All right, the goal is to ensure that your client can meet their future requirements from the assets that they've actually accumulated. So in essence, it really is a cash flow management problem. What you have, what you need, and when you'll actually need it by. In solving this cash flow management problem, there's two scenarios that we really want to avoid for our clients. The first scenario is overspending, and therefore not having enough assets and dying poor. The second scenario is to avoid underspending, and which basically means that people aren't enjoying their retirement. Now, this element is actually not incorporated into most of the solutions that are available in the marketplace, and it really should be, because the whole reason why we forego consumption today is so that we can enjoy it tomorrow. So a good plan, it makes sense that in a good plan that these two bads will actually be solved for. But the uncertainties that we talked about earlier actually make it really difficult to achieve. And if you would try to solve these two bads just independently, the answer is quite simple. It's not sensible, but it's simple.
So in essence, these two bads can be summarised as either under-provisioning or over-provisioning. Under-provisioning or over-provisioning. So under-provisioning is obviously bad because it means your client won't have enough assets to sustain their goals through retirement. Now, over-provisioning is also bad because it means your client's not enjoying the consumption that they've foregone in their younger years. So in effect, they're not enjoying the fruits of their labour. So the solution for under-provisioning that includes investing more aggressively, reducing spending, even re-entering the workforce. Solutions for over-provisioning, they include spending more early in retirement. Now, the issue is that these two bads, they affect one another. So going too far in either direction will risk encroaching on the other bad. So, for example, if the only goal was to avoid under-provisioning, then obviously the solution would be to not spend at all. Easy. But that would increase the risk of over-provisioning. So helping your clients navigate these two bads is very important.
Okay, so to solve for these two bads requires a dynamic approach. We have built a dynamic decumulation tool to help you guide clients on the choices that they can make, on the things that they can control. Now, the best way to actually appreciate what this tool is setting out to achieve is to use the metaphor of landing a plane. So when a pilot looks to land a plane, there are two big mistakes that they can make. They can undershoot the runway or they can overshoot the runway. You simply can't just hold a steady trajectory and hope for the best, because that would be akin to flying a paper airplane, right? Where you just throw it in the general direction you want it to go, hope it lands where you'd like it to, but invariably it probably won't. When flying a plane, the pilot needs to respond to their environment. Are there crosswinds? How much fuel has been used up, and therefore how heavy is the plane? Is there a flock of birds ahead of us? Is there a storm on the horizon? All of this information that is happening is taken in real time by the pilot, and the pilot then makes necessary adjustments to actually land that plane safely. If you would ask most people, how do you land a plane? They would probably say, well, you bring the plane in at a nice slope, use any updrafts that you have where possible. However, it turns out landing a plane is a complex control problem, and it requires a very sophisticated computer system to get it right. We're trying to build that for you in a retirement sense. And James, when we were building this, we've had conversations about actually trying to land a retirement portfolio is harder than trying to land a plane, isn't it?
In some ways it is, Jody. And it's partly because some of the variables that a pilot has to deal with don't always react to the pilot's choices. For example, the weather, it doesn't care what the pilot does. Reacting to a headwind in response to, that weather doesn't change the situation or the strength of that wind at all. These two issues are not coupled. The pilot's reaction and the external environment are not coupled. Now, in contrast, in retirement, the age pension system does care about how much wealth a person has. And that's partly a function, obviously, of how aggressively that person invests. So in the retirement setting, one decision can impact another element, and that makes it quite a complex problem to solve. This model is a sophisticated computer system. It periodically adjusts asset allocations and withdrawals in response to changing market conditions, be it wealth, spending, health, returns. The goal here is to increase the chance of retirement success, not just in terms of being able to land that plane on the runway, but also having a situation where the passengers have a satisfying experience as well.
There was a question on the chat about when we're going to actually show the model. If you bear with us for just a moment, we'll get there. We just want to sort of set up so that you understand what we're trying to achieve with this particular model. Effectively, we are solving a complex problem. I hope we've made that, quite sort of abundantly clear to you. And over the next few slides, I'm just going to give you a very high-level understanding of the engine that we've actually built that's driving this solution. So drawing on that plane analogy again, passengers don't need to understand the computer system of a plane. They just need to understand the end result, okay? So if I want to go from Sydney to Melbourne, I know that if I go to the airport, I get on a plane flying from Sydney to Melbourne, I'll get there. Perfect, job done, it's what I wanted. I don't need to understand what the pilot's doing in the cockpit, okay? The point here is a good solution to a complex problem doesn't have to be hard to understand. We've built a system that is computationally very complex and it's a very powerful engine, but we've taken great care to ensure that the output is simple and useful in helping to guide real people to allow them to understand what they can focus on and what are the important decisions that they need to make. It's not an easy problem to solve, but we are going to make it look and feel easy for the end investor and help you focus them on the important choices and not on the things that they can't change. So clients can't control the markets any more than a pilot can control the weather, but they can make adjustments to account for it. And that's what we're looking to achieve here. As advisors, it really is a part of your job to distill something that is complex into something that is clear, just like this picture. The clients don't need to understand the messy details that's happening in the background here to get the results. So this is what we're setting out to solve for you. So just to give you a high-level overview of the complexity of this model and what it is actually doing. The tool that we have built provides you with a wealth bucketing solution. The end result is actually calculated using a dynamic decumulation model. All that simply means is it provides guidance on how aggressively or cautiously a client should balance between three easy to understand buckets of investment in order to maintain their preferred spending schedule. Now, we know when we've been developing this tool that a lot of advisors currently use a form of bucketing in their retirement solution. You will have some rules of thumb and you'll have some really good intuition about how to move between the buckets. So if you've had a really great year, you know that it probably makes sense to de-risk and lock in some of those profits. If you haven't had such a great year from a performance perspective, probably need to add a little bit more risk into the riskier bucket. What we are doing with this tool is taking those intuitions and supercharging them for you effectively. Now, we've done this using stochastic dynamic programming. Now, this is a really advanced technique that solves complex multi-period decision-making problems. Essentially, the technique is used where we're trying to solve a problem where there is some degree of control. So in retirement, we can control what we spend. Where there is uncertainty. In retirement, we're uncertain how long we'll live for. We're uncertain about what markets will actually do in terms of the returns that it'll provide through to us. And where choices are actually made over unfolding timeframes. So given the client preferences for spending, for end wealth, and an estimate of their life expectancy, the approach works backwards to determine an optimal investment strategy with the highest expectation of meeting that client's goals. So it's a dynamic model. It is not set and forget. It's actually designed to be incorporated into the annual review process. We're providing you with a tool effectively that will support and enrich conversations with clients and help them understand how to alter their asset allocation and their withdrawal rates each year in response to the actual experience. Just like the plane, the pilot responds to the actual experience at that point in time. Now, the model brings together best practice from investment theory, but behavioural science as well. So from an investment perspective, we incorporate our capital market assumptions, our risk modelling capabilities, and their application across multi-asset portfolios. From a behavioural finance perspective, the model ensures that we're taking into account the satisfaction of the client. So the satisfaction the client will receive from enjoying their retirement in the way that they envisaged. So we're talking about the two bads here, and in particular, that second bad that most solutions don't focus on. So being poor in retirement is definitely terrible, but not enjoying the resources that you've worked so hard to save for is also no fun. So the model understands that there is an emotional value attached to retirement, and in particular, spending preferences in retirement. People we know get happiness not from looking at their money or telling other people how much money they have or cuddling their money at night if you're so inclined, but from actually using it the way they want to, from spending it. So we've actually been quite privileged and been able to bring together the best practice of two social sciences, because at Morningstar we're quite lucky to actually have a behavioural science team which is headed by Ryan Murphy. Now, a lot of you on the call today will know Ryan, and he has actually been integral in the development of this tool.
Just on that, Jody, I'd personally say that Ryan is among the smartest people that I've ever worked with, in my career. And, it's been wonderful working through this process over the last year or so. Now we take this construct that we've been talking about and effectively distill it into three buckets. Now these buckets, they're used basically for ease of communication. They're just a projection of the asset allocation. Now we know that people use mental accounting. That's the essence that underpins bucketing. So separating the asset mix into buckets really is designed to firstly increase the likelihood of having an appropriate asset mix, and then secondly, have people stick to that asset mix through the various phases of the market cycle. So there are three buckets. There's a cash bucket, there's a sequencing bucket, and there's a longevity bucket. Now the longevity bucket to the right, it's predominantly invested in growth assets, shares, infrastructure, listed property. Its goal is to grow the wealth in the long term, over the long term after inflation. So it carries an investment horizon of 9 or 10 years. Sequencing bucket in the middle, it has lower potential drawdowns, but with that too, it obviously has far lower return potential. The sequencing bucket has around 30% exposure to growth asset, and it carries an investment horizon of at least 3 years. Final bucket there on the left, that's the cash pool, and obviously is available for use in the short term. But the key is we don't start with these three buckets. Are the asset mixes mapped and presented in this form?
Okay, so we're going to get into a case study and show you what the tool does. And we are going to start our first live poll. So please participate. Meet your client for today. Meet Jenny and Steve. A poll should be coming up on your screen. We would like you, with the information that you have here, to give us an understanding of what you think the bucket mix should be for Jenny and Steve. So ignore the cash bucket. We're talking about the allocation between the sequencing risk bucket and the longevity risk bucket. So just while we're waiting for some of those poll results to come through, Jenny is 67, Steve is 70. They have an aggressive profile. Is someone saying send the poll again? I'm not sure it's worked. We'll just send that back through. Initial advised investments of 1.25 million. They would like $100,000 of a cash buffer, so $100,000 in their cash bucket. Desired wealth buffer is 120. There's no additional bequest over and above that desired wealth buffer, and their cash flow requirements is 60,000 a year. They own their own home. Okay. Okay, so we've got some people coming through. So you get to choose between 0 to 100, 25 to 75, 50, 50, 75 to 25, and 100 to 0. Okay, so let's have a look at the actual results. I'm not sure if we can show them, otherwise I can just articulate to you. I'm just going to articulate in case we have a malfunction. So the vast majority of people are actually saying 50-50. With 25-75 coming up close behind. All right, so let's have a look. What we are going to do now is we're going to walk you through some of the screenshots. What you will see is the interactive version that we're using for design purposes. This is not how it will look for your end clients. It's currently going through a user design experience so that it's quite easy and intuitive. But we're going to show you kind of under the bonnet here today. Yep. There we go.
Yeah, so as we said earlier, we're going to showcase what in effect is an earlier version of this tool. And, it's a taster, but it will give you a sense of that computational functionality. So we'll walk through the various components. We'll then apply them to this case study to Jenny and Steve. What we firstly want to do though is explain the various components on this page. So in the top left, inside the red rectangle, we show the marital status and the age of the client. Now, remember, this is just a summaries page. So you'll have already entered more comprehensive information prior to this. Here we wanted to compress all the key dials into one concise format. So here you can just see the age of the partner with the longest life expectancy. And in this case, the 67-year-old female has the longer life expectancy of 2. And so that's Jenny. And if we turn over, thanks, Jody.
Yep.
So the tool then computes from this the investment horizon. And you can see this in the middle under the word summary. The investment horizon references the Australian life tables at a percentile of 70. So we don't use simply the life expectancy. Obviously, the problem there would be there's a 50% chance they will live longer than that life expectancy. So the percentile's increased. In this case, Jenny has a 70% likelihood of living 27 more years. And effectively, that's the investment horizon that underpins the calculations. So there's also a tab to select whether or not they rent or they own. The tool itself estimates the Social Security implications. So there's a need to collect various inputs that relate to that. And obviously this is one of those. As we mentioned, Jenny and Steve, they own their own home, and that's been selected in this case. So next we consider some of the key financial metrics. That includes things like spending goals and any constraints around things like their risk tolerance. So the dial on the left is known as the RTQ limiter, risk tolerance questionnaire limiter. And what happens here is the selection serves to effectively cap growth exposure, not only for today, but into the future. So the asset allocation will stay inside the chosen risk profile. For example, if balance is selected, that will mean total growth exposure is capped at below 60% through time. If growth is selected, it means exposure to growth assets is capped at below 80% today and into the future. So you can turn this risk limiter on or off. You can show what it does to the scoring, but we'll come back to that a little bit later. Now, you can also enter key information like the annual spending target, together with any big spending items that are expected to occur and are planned. So at this stage, the spending target is $60,000, and that's post-inflation. There's also space to enter how much of a cash buffer they want at the start. It's also important to have somewhat of a buffer at the end. This is not an exact science. You want to reduce the likelihood of running out altogether. That's a disastrous scenario. So it's important to have some buffers incorporated, and it's prudent to do that. So in this case, in the case of Jenny and Steve, they've selected a wealth buffer of $120,000.
Okay, so let's go back to our poll results. So it looked like the vast majority of people said 50-50. There were some that said 25-75. What we have up here at the top is basically, so the cash, don't worry about that because that is the buffer that they said that they wanted, okay, at the beginning of the planning process. That's the money they want on hand to meet their spending requirements and a little bit extra in case they go over the 60,000. So we're talking about the allocation between these two buckets. What might surprise quite a number of you is that actually Jenny and Steve, given the information that we've provided, do not actually need to allocate anything into the longevity bucket. They actually can keep all of their investable wealth in the sequencing risk bucket. So it's not what most people thought. Over here, we give you the breakdown of the accompanying long-term asset allocation, which is based on our recently updated risk profiles. But for the purposes of the rest of this demonstration, we're just going to focus on the buckets. And James, I'll get you to walk through maybe some of these slides, some of the things down below here.
Yeah, thanks, Jody. So effectively, there's 3 simulations shown here. The first of those shows simulated wealth through time. It relies on 1,000 underlying simulations. The bold line in the middle, the black bold line, it shows the median, the 50th percentile. The grey lines show the range of outcomes. So each line, each grey line, I appreciate it's hard to see, it represents a decile. So in this case, you can literally it's very hard to see the grey lines because they are so close together. They're like a grey cloud. But for each of the charts, the highest and lowest grey lines are effectively the best and worst 10% of simulated outcomes. So,
and James, just on that, those grey lines are close together because this client's not taking a lot of investment risk. So the degree of uncertainty is quite compressed.
Exactly. And in this case, that means Jenny and Steve, they're in good shape. Their investable wealth, it's projected to last the full 27 years. And you can see that, yeah, as Jody said, the grey lines, they're not too bad. There's only a small chance of running out of capital altogether. And at the same time, you know, the cloudy grey bars above, they show they're not likely to have significantly more than necessary. So they're in good shape. They're managing the two bads pretty well. But that all, you know, assumes they spend exactly $60,000 per annum and never make a significant purchase. And in reality, we know this is not set and forget. This is not a paper airplane.
Do you want to run through age pension for us there as well, James?
Yeah, sorry. Thanks, Jody.
That's
So
okay.
the next chart here, it shows, you know, the simulated age pension entitlement together with, again, the likely range around that. And as you know, as in the first chart, this is reflective of the uncertainty attached, in this case, to different return outcomes. So again, the bold line shows the 50th percentile. What we're seeing here is the age pension effectively kicking in after 11 years on average. So it could be, in fact, as soon as 8 years, you know, if markets are very weak and wealth is depleted. But it could be up to 13 years if markets are strong and we have a situation where wealth is effectively more than expected. So in this case, Jenny and Steve actually become eligible for the full pension after about 23 years on average.
So let's go back and focus on those poll results again and the intuitions that people had and why they might actually be sort of a little bit different. Down the bottom here, as James mentioned that with the information, we then run Monte Carlo simulations in the background. So there's 1,000 simulations occurring on the potential outcomes that you could receive in the market. Now, this is actually showing you the estimated longevity bucket exposure. You can see where my cursor is down the bottom, the box highlighted in red. The black flat line is the average. So on average, they will not need to hold anything in the longevity bucket. However, this completely 100% depends on is a function of the market environment. Let's just say, so these grey lines represent different deciles of potential performance outcomes. We'll look at this and you can see my cursor hopefully at this light grey line here. What this light grey line represents is the 10% of the worst 1,000 simulations. If this occurs, then this client will actually need to hold about 80% of their investable wealth and longevity bucket. So what we're talking about here is straight out of the gates. There is, you know, really poor markets. There's a sequencing risk event. And even though on the surface, Jenny and Steve look like they're pretty good and they're okay, they will actually have to take a reasonable amount of risk. If we go down to this one, there is sort of a 20% chance, remembering these are deciles, that they'll have to have 40%. So again, people form intuitions about the buckets, but they can vary substantially based on the environment in the same way that that pilot has to alter the way that they're maneuvering the actual plane. The last thing I will draw your attention to before we make this a more complex plan is the strategy score here in the middle. So the strategy score is 93. As we said, Jenny and Steve are in really good shape at this point in time, hence the noted by the good shape. What you can think of this score as is it basically measures how on track you are given where the client is now, where they want to be in the future. Okay, so a higher score is better, and a lower score means that there's some incompatibility between where the household is, what's happening in their plan, and where they say they're aiming for. So the lower score could come from either of the two bads. So, for example, if the client was actually under provisioning and starting to spend too much, they would start to move down into these yellow and red zones. So they would effectively be undershooting the runway. If they started over provisioning, so pulling back their spending, they would start to move up into these yellow and red zones. So they would start over provisioning and overshooting the runway. Now, what's really important, you can see that there will be a range of outcomes that will have them in good shape. So going back to a comment James made earlier is that there is no one solution. There are a series of trade-offs that the client needs to make to then get themselves in a position where they're likely to meet their goals. I'd also point out that being in the yellow or the red zone is not necessarily bad, okay? You, like any good race car, you can run a race car in the red zone for a period of time, but you can't do it forever. You have to make some adjustments. So this is the same, right? If you are actually in these zones are starting to warn you that something in this plan will need to change because you're starting to increase the uncertainty of you reaching your particular goals. So we're going to make this, sorry. Yep.
Sorry, Jody, just before you continue, we're just getting a few questions around what is meant by a wealth buffer. Are you able to define that?
Sure. So the wealth buffer is basically, because we don't know when time T is, which basically the time of death. A wealth buffer allows for that not to be right effectively. So you can see here that the client says, well, we want 2 years worth of cash flow available. If they do actually happen to sort of die in the estimated time frame, then that wealth buffer becomes their bequest. You can see in this panel just below where my arrow is now, an additional bequest could be added in, or the client could choose their wealth buffer to be their bequest. So effectively, it's accounting for the fact that time T isn't perfect, effectively, and we want to make sure that you don't get towards the end of life and have no money.
And does that buffer sit in the cash bucket?
No, it's investable.
Okay.
Yep. So what we're aiming for is at the end of this plan, in 27 years, there'll be 120,000 left. Okay. Right, so going back earlier, we talked about the age pension, and for this couple, on average, where the dark line intersects here, they will have the age pension kick in at 11 years. So next poll question. Jenny and Steve are in great shape. They don't have to take any risk. They're not in their longevity bucket, but they've told us that they're happy to take risks. Their R2Q limiter, let me get that out, is aggressive. So the conversation you're probably going to have with Jenny and Steve is you should spend more. You can afford it. What would happen if Jenny and Steve increase their spending from $60,000 to $62,500 a year? So a $2,500 increase. What do you think the impact will be on their age pension? No impact on when it actually commences. Will it commence earlier or will it commence later? I'll give you a moment to see these results coming through. And a whopping 83% are saying that they will actually commence earlier. Sorry, don't get that. Well, let's see. Are you right? Sorry, you're not. Now, this is coming back to that plane analogy of, and why it's harder to land this than it is a plane, because the environment reacts to the decisions that we make. So this client is simply adding another $2,500 a year to their spending. Now, that sounds like a really modest amount. And I completely understand everyone's intuition of saying, well, they're spending more, they'll pull their wealth back faster, and therefore the age pension should kick in earlier. However, to be able to spend more, $2,500 sounds like a really small amount, but it's $2,500 a year for 27 years. So it's not an insignificant amount of money. So to be able to actually spend to that level and still have these other aspirations of the wealth buffer and the cash bucket, the client will now need to have 28% of their investable wealth in the longevity bucket. So that would surprise most people because that's a fairly big tick up from zero. Now, because you are actually investing more in the longevity bucket, you are taking market risk and therefore you're more likely to be building your wealth. So spending more results in the need to actually have a slightly more aggressive asset allocation, which will impact your wealth, which then ultimately impacts the timing of the age pension. And in this case, it pushes us out to year 12. What I'd also highlight down here below is that this outcome could change. through time. So what we show is that on average, again, they need 28% in the longevity bucket. But again, straight out of the gates, what could actually happen is that if you look at this bottom light grey line, this is the best 10% environments. Straight out of the gates, absolute fabulous years, perfect. They've locked in the additional capital they need to fund that spending, and then they can de-risk. So they could technically de-risk and go back to having nothing in the longevity bucket by year 2. Conversely, that could actually expand out quite significantly, and they may not be able to de-risk until year 18. And you can see here that these grey lines have started to expand because we're introducing more uncertainty into this. So James, should we ramp up this example? Let's get our client doing more stuff.
Yep. Okay. Well, let's do. Okay. So Jenny and Steve, they want to know the feasibility of travelling around Australia, and therefore the question for you all is.
Next poll, please.
Next poll.
There's 2 polls actually. Can we do 2 polls at the same time?
Yep. So we'll have question 3 and 4 if you can answer those on your screen.
Effectively, they want to buy a Winnebago. That Winnebago is going to cost $110,000. They want to do that in 2 years' time. Question is, can they afford to do that?
Yes, no, maybe, but not wise. And the second question, which should be available for you to answer as well, is how will the longevity bucket exposure change? So remember, it was at 28% before. What will it go to?
And just looking at the results as they're coming through, 63% of people say yes to the first question. They can afford it.
They worked hard. They should be able to get a Winnebago.
The second question is more split. So basically, in terms of the 2 most popular answers are 65% and 55%. Only 13% suggest 85, and a smaller proportion to suggest 35.
Okay. Should we see what happened?
Yep. So let's add that to the system. That's what you see. What happens is the strategy score goes down to 86. And they're still on track. They're still in pretty good shape. But to meet this goal, it's going to require higher returns. So that means the portfolio will need to invest more aggressively. In fact, 65% will need to be invested in the longevity bucket. Now, the reason why this strategy score has come down slightly to 86 is because if markets do go poorly, buying that RV or Winnebago, spending $62,500, that may not be sustainable. You can see here there are scenarios where investable wealth's exhausted early. So that top chart on the right, more growth. It lifts the return expectation, but it carries a much wider range of potential outcomes. In the second chart, you can see the age pension. It's expected to commence after 11 years. Yep. It could be earlier. It could be later. And then finally, that longevity bucket simulation at the bottom, it's showing, if there are good markets straight out of the gate, it may be possible to still de-risk quite early. If markets are very strong early on, in that top sort of 10%, it could only be 3 years before they're fully out of the longevity bucket. But if markets are poor, it could be up to 18 years before they can afford to move out of that longevity bucket.
So what we've done here really with this spending is we've increased uncertainty. Again, that's okay because it's about trade-offs and understanding those trade-offs. Okay, so we're going to actually maybe stop the polls because I'm conscious of the time, but if you would like to interact, please use the Q&A function because we can capture your questions. We're getting a lot of questions through and we may not get to them all before time's up. If you use the Q&A function, we can capture them and definitely come back to you. We lose anything that's in the chat once it's finished. Okay, so Jenny and Steve, because they love their grandkids, in 5 years, they would also like to help fund their grandkids' university. So they would like to contribute $160,000 in 5 years' time. Okay, so let's see what that would do to our model. So you can see down here, we've inputted another big spend, $160,000 in 5 years. Okay, their strategy score is now 76. They're in okay shape. Remember, yellow is not bad. It just means be careful. It just means that you are starting to introduce more uncertainty into whether or not that end goal will actually be met. And you're introducing more uncertainty because what's occurred is to be able to actually maintain your spending at 62,500, get the Winnebago, fund the grandkids, still have that wealth buffer at the end, all of their investable wealth will need to be in the longevity bucket. So you are introducing a significant more amount of uncertainty into this plan. And as a result, you can see that these grey lines start to sort of move out like an accordion effectively, because there are different results that can actually occur. Now, why this is useful is that this actually then really helps you have a conversation with your client. And if you know a client, what we know here is that there's not a lot of room to slip up in this plan. Okay, they're in the yellow zone. If markets go poorly, it's not going to be great. If they overspend, that's also not going to be great. So if this is a client where you know that this household is more likely to overspend and this 62.5 is probably going to be 70, then what you would do as a part of this process is advise them against one or both of these or reducing the amount. So it allows you to have those really interactive conversations with the client. So you can almost imagine that, you know, when we get this into the user interface, sitting there on an iPad, and they can, you know, put an input in over here and see what impact it has over there. And they go, oh, I don't like that. Let's change it. Okay, so let's see what happens. Let's see that in the process of actually having this conversation, Jenny goes, oh, I really don't like all of our investable wealth being in the longevity bucket. It just feels like it's too much risk. You know, I don't like it. Can we do this without any risk? No. So what we've done is we've turned the risk limiter down to moderate. So this is not their risk profile. This is the maximum risk or growth asset exposure they're willing to take. If we do it, you'll see we've gone into the grey zone. We are out of bounds. There is no plan that will allow this client to spend $62,500 a year, buy a Winnebago, fund the grandkids, and have 120 grand at the end without actually holding much in the way of growth assets. So they have to then go back and start thinking about the various trade-offs.
Okay. So one of those trade-offs might be, in this case, to turn the dial back up on that risk profile to growth, no more than 80% growth exposure both today and into the future. Another potential option is to spend a little bit less. So take it back to 60 from 62.5. And we have a situation where they're back in the okay range. They're back in that yellow zone. Longevity bucket up on the right is now lower than it was without the risk limiter. So it went from 93% back to now being at 65%. I think what's interesting here is that, you know, instead of needing to hold that longevity bucket in that bottom chart, instead of needing to hold that longevity bucket for an average of 10 years a moment ago, it rises to an average of 11 years before it falls to zero. So in effect, what you're having is the impact of the risk limiter is that they need to maintain growth exposures for longer, even though the spending in this case is reduced by $2,500.
So it's almost like to that toy that you had as a kid where you'd hit one thing and another thing would pop up. And that's, you know, getting people to understand this is a really complex problem and we all have intuitions about how to solve it, but it isn't actually that easy to solve. We're getting a lot of questions through. I'm just quite conscious. We're happy to stay over if people want to stay on, I think, but we will certainly try to come back to some of the questions. I did see one pop up a second ago about longevity, remembering that this is a dynamic tool. So every year, if you live a year longer, your probability on the life tables changes as well. So this will actually update. And you can actually then put in there your own. So at the moment, we've got it at the 70th percentile. You could say, well, I know that this particular client's got poor health. They've got, you know, issues in their family, etc. It can be changed. So we're just showing you some of the high level buttons that we can actually, that you can actually play with, just to give you some understanding. Now, before we finish off and try to get to some of these questions, let's have a look at the other bad that we haven't really spoken about, which is that over provisioning, right? So they go, right, we're done. We don't want the Winnebago. We actually don't even like our grandkids, so they can fund their own university. And actually, let's just live really modestly for $40,000 a year. Well, you can do it. We know they can do it. They've certainly got the wealth for it. And they just put all of their money in the sequencing risk bucket and live safely. But their score's quite low because, again, we want to take into account that there is value in them actually enjoying their retirement, okay? So they've now gone up into the red zone, the be careful zone, and it's be careful, you're not going to enjoy yourself. You foregoed spending in the early days so that you can enjoy your retirement. This plan will not see you enjoying that retirement. So we'll leave you just, I guess, with this thought, and we'll try to see how many of these questions we can get through. But again, we will capture as many as we can. If you haven't put it in the Q&A, please do so, because we lose anything that's in the chat. Then we'll circle back to you. But effectively, this tool, it's a dynamic decumulation tool. It combines best practice methodology with a simple and intuitive interface that aims to help deepen the ongoing retirement planning engagement process that you already have with your clients, okay? The interface that we showed you today is not going to be the end client interface. It needs to be more client friendly from that perspective. But the tool helps form holistic investment strategy that's built around the client's goals and provides actionable guidance on the trade-offs and the opportunities that they're faced with. So overall, we're hoping that this tool will really help you guide your clients into making smart decisions that will ultimately impact their retirement outcomes. So we will try to get to some of these questions in the remaining 8 minutes that we have. If I do that, it comes up on the screen. Oh, here we go. Okay. James, do you want to grab this one so you can have a look at some of these questions? Sorry. Okay, with only 30% growth, it would be hard to keep a client when the market is doing well. This example works because they only want 60,000. Most clients want 90. Absolutely. We can't do this example live because we wanted to do a live demonstration of the tool, but we just thought it would be safer using Zoom and webinars to show you screenshots. But yes, absolutely. And we would also say, and that's why, granted, we only dialed their spending up from 60 to 62, but you would say to them, you know what? You've told me you're happy to take on more risk. You don't have anything in the longevity bucket. This plan probably doesn't really meet 100% of the goals and aspirations that you'll have. So yeah, you can do that. If they want 90 grand, you can put it in and you can see if that's actually going to be an issue for them as well. And then what other trade-offs they might need to make. As I said, it's meant to be designed where they can turn this dial and see what happens over here and what is the actual impact of doing that within the plan.
And then Jody, so if you have a situation where after a year they've come back and instead of spending 90, they've spent 96, you can update and show them the consequence of that continued behaviour. Yep,
absolutely, absolutely. Because we know best laid plans sometimes don't go to plan, and the client will rock up to them and go, "Oh, sorry, I bought a car and forgot to tell you that was about to happen." Again, it's interactive, it's dynamic, and it's iterative. So the risk profile didn't come into play with the allocation between the buckets. Yes and no is the way I guess I would answer that. So it's a risk limiter in the sense of what is the maximum risk exposure they're willing to take. By going through this process with them, you'll actually get a better understanding of what their true risk profile is. Okay, so it's kind of, we're starting with showing them the outcomes, showing them the workings and where the trade-offs are, then they can actually make a more informed decision about, well, what really is my risk profile? Because I think answering the question of what's your risk profile is actually a difficult question for the average client to answer. So hopefully that helps them sort of understand that.
Just eliminates that trade-off, doesn't it?
Absolutely, absolutely.
What about this question, Jody? What is your plan to update the model based on economic circumstances? So you get 2 quarters of great economic growth versus 2 quarters of retraction, recession. What would you change in the model? When would you update it? So the model incorporates updated balances. You know, what is the current situation? Where are their net assets in response to moving markets, changes, you know, in withdrawals? So you've got that, you know, changing from year to year. The other component here are our capital market assumptions. And, you know, we've just gone through an extensive refresh of those as part of the risk profile update and rolled out our new assumptions. And that's one of the key drivers of the underlying simulations that we were speaking through, those 20-year capital market assumptions, for returns, for risk, for correlation.
And that answers one of the other questions about the what's driving the rates of return that's in the example. It's our capital market assumptions. So as I mentioned, it's the bringing together of our investment capabilities and our understanding of behavioural science to come up with the end solution. There was a question about the age pension based on present legislation. Yes, it is. We know that that's something that moves and changes as well, but obviously that would be incorporated as we go. As the market dips, more needs to be pushed into growth assets. How long is the trigger period of dropping markets? Will one COVID month trigger it? Depends on the size, really, doesn't it?
And when it's updated. I mean, the thinking here is that it's updated each year, potentially, or biannual, at every 6 months or each year.
Yep.
If you update it every day based on market moves, then that, obviously it's not practical.
Yep. There's a question about why is the cash bucket not included in the advised assets? It is, but what we're assuming is that you've had the conversation with the client about how much do you want on hand at any particular point in time. And that gets replenished each year as a part of this process. So this is just access to capital. We've, just for ease of simplicity of going through that example, we just left it as a static part of the process.
Jody, we're running out of time.
We are.
Last question.
Have you got the one?
When is it available and how do we get our hands on it to have a more detailed look?
Okay, so we are currently, what we've shown you is, I guess, the testing version, the pilot version. We have a group of advisors who have been kindly lending their expertise and capabilities in testing the model for us. The feedback that we get as a part of that pilot launch will inform how quickly we get it to market based on what adjustments need to be made. Now, we're not going to try to make it perfect before we launch it. This will be an iterative process and we will continue launching different versions and updating it and making it better based on feedback. But we will certainly keep you well informed as to when the launch date is likely to occur.
Thanks, Jody and James, and thank you everyone for your time today. We really appreciate your interaction and your feedback in this session. Any questions that weren't answered during today's session, we will come back to you on those. As I mentioned at the beginning of today's session, you will receive the CPD points. You can expect those later next week. And the recording will be available along with the methodology paper for you on the back of today's session. So thank you again, everyone, for giving up your time today, and we hope you enjoy the rest of your day.
Thank you.
Thank you.